All right, hello everyone. This is Jack Bosch speaking, and welcome to another episode of the Forever Cash Life Real Estate Podcast, where we talk about cash flow amongst many other things. And today we're definitely going to talk about cash flow, because we're talking with Bob Fraser about note buying, note structuring, note selling, and how you can structure your notes such that you do perhaps with the land flipping that you can sell them easily. We'll get started in just 1 second.
Welcome to the Forever Cash Life Real Estate Investing Podcast with your hosts, Jack and Michelle Bosch. Together, let's uncover the secrets to building true wealth through real estate and living a purpose-driven life.
All right, so we are back, and I'm excited to have the subject that I wanted to have on this podcast for a long time of actually note structuring, note buying, note selling. And our guest today is Bob Fraser. Well, Bob, welcome. How are you?
Great to be here, Jack. Look forward to this.
Wonderful. So, Bob, how many notes have you bought or structured or sold or touched?
To date, about 1,500.
1,500 notes. So we have an expert here with us. I'm super excited for that. So you have a little bit of that experience. You have a whole bunch of experience. You have experience with software before. You created a software company, raised some money for that, and then you've gotten into different spaces. Tell us just a little bit about that, but I can't wait to jump right into the note business.
Sure. Well, my background is a computer programmer, so I was kind of a nerd from Berkeley, did that for many years, and then in 95, I started a tech business, became a big deal, ended up winning the Ernst & Young Entrepreneur of the Year Award for the Midwest region of the United States, became the fastest growing business in the Midwest region in the late 90s, about 300 people we hired. I raised $44 million in venture capital. Then it spectacularly blew up in the dot-com crash. So, I boast my crater is bigger than most. So if you've had a crater, hey, there's life after craters. And then decided to rescue myself by starting a hedge fund, and did that and got that launched just in time for the 2008 crash, and lost money there. And at that point was looking for something that I had a little more control, a little more stability, and got into real estate with my partner. I was not a guy that really liked real estate necessarily. I thought it was kind of boring. And but my partner is a real estate genius. And so I was the kind of the money guy, the finance guy. And so we joined up and started right away with these two very unique strategies in the world of notes. And we love it and are doing super well with this and helping a lot of people as well.
That is wonderful. That's good to hear that after a couple of learning experiences, put it that way.
It's a great way to put it.
you had the opportunity to then get actually into something that that now is working very well, and that will continue to work in pretty much every market.
That's right.
So now notes. So you got into notes. You're buying notes. You're probably selling notes. You're structuring notes. So we, as you know, this is supremely important and interesting for us because, as you know, we're flipping land. Right? We've flipped over 4,000 pieces of land. We are teaching this all around the country. Our students flipping land, and a lot of the land that we flip with seller financing, because particularly in the below $100,000 level, $100,000 value of the property level, banks are really not a factor. They don't lend. They don't give those. They're just not available to give you a loan. Particularly if the property is like on the outskirts of town and not right connected to all the utilities. So when we deal with that, what would you? So tell us how what is even note buying? So for somebody just as a very beginning person that says like, yeah, if I have these notes, what do you mean I can sell the notes? So tell us. We'll just start at ground zero.
Well, generally, right. Anytime a lender gets involved in real estate or seller financing, you create a note with a lien attached to it that secures the note, and that stuff is very liquid. You end up selling it. So this is what banks do. Banks, of course, create lots of this kind of paper. Well, typically banks sell it to Fannie and Freddie, Fannie Mae, Freddie Mac, who securitizes these notes. And there's just the note industry just has 1,000 tributaries and off ramps, and it's a very complex, very robust field. And so we are in that space as well. And there's just lots of niches. So we end up buying these notes from banks, from hedge funds, from private investors, and work them or have two strategies with these. But in essence, we become the bank. So the borrowers, rather than pay a bank, they pay us as the note, as the lender, and we have all the security that the bank would have to basically secure that investment by taking control of that asset if we need to. So we, in essence, become the bank. All that fine print becomes our fine print. It's a very good business as a note buyer.
Right. Okay, that makes sense. So when you, in essence, when you have a note, when you own a note, you're the bank, and the borrowers pay you.
That's it.
So you buy this. So where do you find notes? Where are you buying from typically?
We have a whole lot of sources. We bought a whole bunch of notes from the FDIC recently. And this is, of course, the bank regulator. Now, when they shut down a bank, they usually have a bank sitting ready to take the assets, but that bank takes only the good assets. Okay. The bad assets, the FDIC holds, and they basically liquidate through a number of law firms. Well, we found a whole bunch of mortgages that we just love. I think it was like 500 mortgages we just bought. So we bought from the FDIC. We typically buy from banks. So we will buy notes that are called troubled debt restructures. So this is what happens is, let's say you, in your house, you have a mortgage, you stop paying your mortgage, maybe you had a medical crisis or a divorce, you lost your job, you stop paying that for a while, you get a loan modification, so the bank will modify that note, and now you start paying again. Well, it's now a bad note. Even if you're paying, even if it's a beautiful house, even if there's lots of equity in this property, it doesn't matter. It's a bad note. It's called a troubled debt restructure. And once a troubled debt restructure, always a troubled debt restructure. So literally, the note can never become a good note. Again, it's just forever an ugly, black sheep note. Well, the banks sell these notes, so we buy direct from banks. These troubled debt restructures, we'll buy from hedge funds. So a lot of hedge funds buy non-performing notes. Sometimes they reperform them, and then they'll sell them to us. So a lot of hedge funds, a lot of people are buying. If you look at these auctions, the Fannie Freddie FHA auctions, they're auctioning off bad notes. So some of those end up turning into good notes. We'll buy those. We also buy seller finance notes. So this is where, as some of your listeners might create paper, you teach people how to create paper. So let's say a person wants to buy this home. They don't have enough money to do it. They convince the seller to do a seller carryback. So they'll create a note and a lien by doing that, and then we'll buy those liens as well. Right. So there's really a lot of different sources, and this is for one of our strategies, really the performing strategy. There's just lots of different sources.
And now, if I may ask,
buyers in the space right now, people are coming to us with their seller finance paper and their reperforming paper.
Okay, now that's great. But so where do you have the money from to buy these notes?
Well, we've structured funds. We've got a 7-year track record. So once you get a track record, it's fairly easy to raise money. So we've got a very, very tight operation, a very sophisticated operation, a very compliance oriented. It's very investor friendly, very bankable kind of operation. So, and with a long track record, so we raise money from private investors, and we also have some institutional relationships as well.
Okay, I got it. So basically, so institutions and private investors, they get a yield, and then you ideally, correct, you operate at a higher yield, and you get the spread in the middle.
We make the spread. You got it.
Okay, which
is what even a bank does. Banks borrow money, and they make the spread. It's called net interest margin.
Right, absolutely. Great. So then the other. So now let's jump into so if somebody creates a note, for a note, or let me ask it this way: for a note to be interesting for you to purchase, what kind of key parameters does it need to have for it to be sellable?
Sure. Well, our general philosophy is there's no such thing as a bad note. there's only a bad price. So,
Okay.
so if you create a really lousy piece of paper, you may not get much money for it.
Okay, what is a lousy piece of paper?
Yeah, very, very good question. A lot of things can make a lousy piece of paper. For our, if you want to maximize your value of this note, number one is it should be performing, meaning there needs to be a regular income stream coming in. Number two, the borrower should be credit worthy. So there should be, decent credit. We don't look at that much, be honest, because we're typically looking, we know, we don't mind taking control of paper. You want it to be high yielding, higher interest rates are more attractive. And then the other is security. You want to make sure that loan has no more than 70% exposure. It's 70%. It's covered by equity of 30% or more. So 70% loan to value ratio is generally a good note. Anything out of those parameters, the price we pay drops pretty dramatically.
Okay. So if it's in those parameters, what do you typically pay for a note? If it's
it's all yield based. If you're giving me a very pristine note that's got a good borrower, credit worthy score, it's a 50%, investment, loan to value ratio, and it's 10% paper or 11% paper, I'll pay full price for that. I'll pay par. If it's a, so generally we're yield-based buyers. So we like to buy around the 13 to 14% yield. And so you can calculate that yield, as the yield, multiplied by the discount, and see to get what's your 15% yield. But we also do a risk-adjusted yield. So we actually model this. What is the likelihood of default? What is our recovery in the event of default? And we price all that into the price. But generally we're yield buyers. If you price in a 13 to 15% yield, generally we're going to be interested.
Okay, very interesting. That's good to know. So just to give you a little feedback, or not feedback, but information here on what we do is, and what our students do is, we buy pieces of land at very very big discounts, and then we turn around and sell them usually at somewhat of a discount of market value with a decent down payment, but we charge often 12 or 13% interest because, again, the banks don't really look, they're not in that space, and even on land, bank tends to charge a little bit more interest anyway. So so these things already produce a 13% yield as a performing notes. The only thing a lot of our students and we ourselves don't do is we don't check the credit score of the owner, of the buyer. We basically go and just and go by the down payment. If they give us a $10,000 down payment on a $50,000 note, we're happy as a clam because we know they will never default. If they give us a $500 down payment, then they won't even get the deal. Let's put it that way. So, but if you look at it from that point of view, are you looking for equity in terms of equity loan to value, or equity in terms of down payment to note balance at inception?
I don't look at down payment. Obviously, that would go to your originator. The down payment would be, so that doesn't matter to me as a note buyer. What matters to me is the loan to value ratio and the borrower's ability to pay. So what generally I'm paying preferred return to my investors. So I'm a cash flow buyer. So I want to know that cash flow. Secondly, I want to know that if that cash flow ceases, that I can recover my investment.
Sure.
So in your case with land, how is it producing income? I would certainly, before I would buy a note, I'd want to know that income is likely to continue. And so I want to know generally what's behind that. Why is there income off this land? Land generally,
no, there's no income off the land,
right? So
there's no income off the land. The buyer just pays the note. The buyer pays the note because he uses it for his weekend. He uses it to down the road build something. He uses it as an appreciating asset in the path of growth or different kind of things. So the land.
Then I want to see I definitely want to know what's the likelihood of that payment stream continuing. Or in that case, I would want to, if there's we're totally blind on that, I'm going to want a very aggressive loan to value ratio because,
in other words, a steeper
that's, again, I'm not in the business of losing money. So
sure. No, and that is exactly, I love this conversation because when we do have our seminars and I stand in front and I talk about note selling, I always tell people, if you want to sell a note, you got to exactly know these items. So what would you do? What would you require to know that a buyer has the ability to pay that note to a large degree?
Yeah, generally you should try and get a financial package from the buyer. You should have, kind of an income statement, financial statements from the buyer. You can pull credit, get a credit score. There should be a personal guarantee, maybe that's tough, but it's a big deal to get a personal guarantee where, especially if there's not income on the property, then what's my source of income? It's the buyer alone. So I've got to make sure that that's going to be coming. Or if I end up having to foreclose and take possession, then do I end up with a piece of property that's now burning a hole in my pocket while I sell it because again it has no income. You follow me? I can't rent it. So I want to know about that buyer. Secondly, I want to know about income opportunities for that property. To basically say, okay, worst case scenario, I end up with this. Is it going to be burning a hole in my pocket? Or it's negative cash flow all the time. You follow me? I don't want that.
So
I've got to pay my investors on a monthly basis, right?
Yeah. And in full disclosure, we have actually never sold a note because we don't want to sell the notes. Like we built this business such that we have hundreds of notes paying us hundreds of dollars each every single month, and that just brings in cash flow like crazy and into the door. Why in the world?
Well, that's great, Jack. But here's the issue. How much money do you make when you flip? More, right? Your returns are higher.
No, the overall, well, the annual returns are higher, but because of the velocity of money, and I can reuse that money. But
that's my point. So
the overall spread is much higher. The overall return is much higher with selling it with a note, because usually when we flip, we discount the properties dramatically.
Well, that's what I mean. But okay, so if you create the note. Okay, but we're talking about two different things here. So let's say you create the note. Once you've created the note, now you could collect, let's say, a 10 or 11% return, which is super good. But if you were to sell that note and go do it again, you actually velocity money, you're going to make a much higher return. Right. Our number one customers or sellers of notes to us are hedge funds that literally they basically take the money, they deploy it into these assets. Once they create the paper and they have low velocity returns, they sell them off because they're making more money in high velocity returns, right? Where they're operating their acquisition, value creation business, and they're making way more money doing that. So I would argue that a good business is going to be, as long as there's opportunity to buy, as long as you can continue to acquire the land and continue to create the paper, you should do as much of that as you can and get, sell off your low velocity, low return assets in order to buy new. Now, if the market changes and those opportunities disappear or they start to slow, then you stop the acquisition business and you begin the milking business, right? Where now you just sit on the low velocity returns and you're great, but you've pyramided at that point. You've pyramided and you've built your base.
Right.
So that's why a lot of people use us.
And in essence, without selling the notes, we have done that because in our land flipping operations, when you buy at 20 cents on the dollar and you sell at 80 cents on the dollar with a 20% down payment, you basically already got your investing capital right back. And now the note, extra cash coming in. But even there, instead of selling the notes, what we sometimes do is we go to our own borrower basis to the people who make the payments. Is like, hey, I'll give you a 10% discount if you pay off early.
Sure.
And that worked easier. But but I follow your logic 100%. As a matter of fact, in one of our events, we always do exactly that. We look at that. We look at the time factor. We look at the return factor. And we look at, like, wholesaling might give you you triple your money. Seller financing, with over 10 years, you make your money tenfold. But if you build a note and sell the note within like 6 months, 9 months, you're right there in the middle.
Right.
With a tremendous return, and you can redeploy it, and you still get some cash flow.
Well, your margins are so high, your returns are so high. Right. If you're buying it at a 20% discount and selling it at an 80%, well, I would advise anyone who is able to do that as often as they can, and that means sell off. If you're only earning a 10% on the back end, I would sell as much as you can of that to buy as much as you can of the opportunity. Again, it's opportunity constrained business you're in, right? So if the opportunity is there, you should sell the notes. If the opportunity is not there, you should hold the notes.
And that's why I'm so excited about our call right now, because there's a whole bunch of students right now of people that we taught this, that are running into the following situation. And the following situation is that they buy something, let's say they pay $5,000 for it, but it's worth 40. They go sell it for 35, and they get a 5,000. They only get like a $3,000 down payment. Now, in that scenario, they could technically sell that note to you at a steep discount, right? And you probably, in such a scenario, would ask for a steep discount because the loan to value is too high, the down payment is lower, and they might not have that much information about the borrower. So you might have to ask for what, a 50%, 40% discount on the note like that?
Maybe. Yeah, maybe.
Mm-hmm. But it still might make sense, because now they can take that piece and turn that into a $20,000 payday.
Exactly.
And then now take the $20,000 and do 4 more deals like that without actually having to sell the note, or sell them again, and then they have $80,000. And now they use the $80,000 to do 20 of these kind of deals.
Exactly.
Don't need to finance, don't need to sell the notes anymore, because now that brings them 20 times $400 is $8,000. It's almost $100,000, and
that's right.
They can sit back and enjoy life for a few years.
As long as the opportunity is there, I would argue you shouldn't be holding this. But as soon as the opportunity softens or you get busy, you can't do that. Then but you're always going to make more money with those kind of margins. You're going to make more money in a velocity model. I know, because we buy non-performing loans as well. That's another one of our strategies. And in that strategy, we sell as much of that paper. Once the note's performing, we get rid of it as fast as we can, even though the yields are great on it. But we're not a yield buyer, or we're not. We make far more money taking that money and buying more of those assets because our margins are so high.
Right, because you're buying the non-performing note here, and
we're buying at 20 cents on the dollar
here. It's worth that. And in that case, you go sell it because,
that's right. So your listeners should do the same. As long as the opportunity is there, the way to make a lot of money in a very short amount of time is to do as many deals as you can, as long as the deals are available. Right. And just do them as often as you can, as quick as you can.
So what is the minimum amount of minimum note value that you would buy? What are you not dealing with below?
We generally won't buy anything below $25,000. It's just not worth our time. We'll look at anything. If we're buying a bulk package and there's some $15,000 notes or $10,000 notes, it's okay, as long as we can. But servicing costs end up becoming a significant factor when the notes are so small, So, but we buy onesie twosies. We'll buy notes that are we'll buy single notes, especially if there's a relationship. We have a full-time underwriting desk. All they do is price notes for people. So send us your note, we'll price it.
Okay.
And,
wonderful.
The land would be a different deal for us, because we'd have to really look at that and look at the, how secure is the income side of that. But
right. So what I hear from you is that if somebody, and that is why we're going to make a big deal of this podcast interview and put it into our group and everywhere, so people really can listen to that and understand what you guys are looking for. So what I hear you say is that you hear that you in particularly with land. Basically, before I say that, my understanding, therefore, is from what I hear is that you are actually preferring rental properties being sold to notes and rental properties being sold to you over owner-occupied properties, right? If it's in
No,
house.
we definitely prefer owner-occupied.
Okay, but isn't the owner-occupied also by definition a non-income generating asset? But what you mean is like it can generate income if you move them out.
That's right. If I take possession of the property, I can rent it out. If I had to, let's say the world crashes,
Right.
I want to know that what are my choices here? Well, there's a robust rental market, certainly the pricing is, discoverable quite easily in residential property, but
Sure.
I definitely prefer owner occupied because it's sticky, being home sweet home, people don't want to move, so.
Right. Okay. I got it. So based on that, if the issue with single family, that's first of all is with land is that first of all it's not owner occupied. Secondly, it's by definition not income generating. So therefore, that means that if you buy a note from that, the information about the borrower needs to be extra good.
It does. It does. It would have to be good. I'd want to see a guarantee. I'd want to see financial wherewithal that they're likely to continue to pay this and certainly have the ability to continue to pay this.
Wonderful. So the message,
that's first of all, I don't want to foreclose, right?
Right.
I know that, but I don't want to do that. So I want to know that there's a reasonable chance that I'm going to get paid on a monthly basis.
Absolutely.
And barring that, I want to know that if I have to take possession of this, I'm not going to lose a dime.
Right. And so with that said, so for you listening, if you're doing the land flips like we teach them and you want to sell the notes and you understand what we talked about earlier, that because of your margins are so high that you're potentially better off buying the property, like selling it with seller financing, and then selling the note very quickly because you realize like 2/3 of the overall profits that you would otherwise, but in a short period of time, and then you can do that for as long as you want to, and then build out your seller financing portfolio later on. Once the market perhaps changes, then make sure if that's something you want to do, then from starting now, make sure that when you sell a property, that you really ask your buyer for some detailed financials, for permission to run his credit score, which our paperwork allows you to do, but just make sure you use this paperwork, that you have the permission that when you sell a note, that the buyer can also run the credit score and those things, because the ability to sell that note at a good price will hinge ultimately on the ability of the buyer to make the payment, because the property itself will not be able to generate income.
Yeah, absolutely. And if any of your listeners don't do this, they should. The note should be professionally documented, professionally papered. You should get a lawyer to write the note so that it has the standard provisions and protections that a lender expects. And those vary by state. So if it's kind of a hand done deal and it's done clearly not lawyer, I wouldn't touch it with a 10-foot pole. So
that actually gets me to the next point. Great segue here, and that is because we don't sell our notes, we use wherever we can in the states where we can, we use land contracts. So basically, number one, do you buy them? Generally speaking, you touch them. Number two, if you don't, then what you just said, Bob, comes in that. But let's first ask the question: do you buy land contract?
And I don't understand land contracts. We've never bought these. So what is a land contract?
A land contract is basically a hybrid document that is a combination of a sale agreement where it says, I, Mr. Buyer, buy from you, Mr. Seller, this property, and the terms, and basically it's a note and the sale agreement combined into one piece.
Okay.
So it lays out the financials. It's the only piece of document that needs to be signed. It's been professionally done by an attorney, obviously. And basically they sign that, you pass it on to a loan servicing company, they all accept it, and they start making payments. And in the documents, it's a 3-page legal size document. And in the document, it also specifies the foreclosure rules and how those ultimately happen. So as a result, it specifies it's all up to the truth in lending and all this kind of pieces. So it has all the different line items in it. but it's the same time, it's an agreement between the buyer and the seller to sell and to buy, and it has the financial terms built in. So basically it's the sale agreement and the note put together into one document.
If it was done by a lawyer, I would probably be open to that. To me, I would want to see that it is, secured by, I want to make sure the lien is properly securing the asset. I want to make sure that I have a right to run a credit on a regular basis,
right.
That they're personally guaranteeing this note, this kind of thing. So I'd want to see those things are in there, and I would have my lawyer review it just to make sure. But yeah, it should be professionally done. The last thing I want to do is get a CFPB violation for a note I just bought, and I've got some ridiculous kind of, note, generated a piece of paper that's not worth anything. So
you've had your learning experience, so I understand you're playing everything by
yes. Yeah. So get it professionally done. I mean, pay. The worst thing you can do is try to save money on lawyers, in my opinion. Okay?
I agree.
I hire a lot of lawyers, and I pay them whatever they ask. And I made a lot of mistakes by saving money on lawyers, and I just don't do it anymore.
I agree with that. So my attorney likes me a lot because he always says you're one of the few people that actually understands that we actually don't cost you money, we actually save you money.
That's exactly right. So if you're listening, here's two guys warning you, telling you, begging you, please use good attorneys and pay them what they ask, and don't do it yourself, because
right.
As good as Nolo is and all these Google, they're just not good. So
right. Absolutely, I agree with you. So great. So in summary, then, but you still prefer a well done deed of trust and note, usually, probably.
Absolutely,
right?
Absolutely. To me, that's automatic. For us, we run that. We don't pay any attention to that. It just goes through the system.
Right, exactly. So again, as I say in our events, in our webinars, in our things, that if you want to sell the note, recommend get yourself a deed of trust and note for the state that the property is in. Obviously, we're not attorneys, so we have a lot of paper documents, attorney-generated documents in our program, but we don't pretend to be attorneys and create stuff like that. So you need, if you use our land contract, which we have a couple of states specified and a generic in the program, but just generated by our attorneys, not touched by us. But if you want to sell the notes, then talk to some note buyers, just like I'm right now. And the consensus is that what you just said, that a deed of trust and note goes straight through the system. They know it, they understand it, they're used to it. And so if your plan is sell a bunch of your notes, then structure them right from the beginning the right way. Get all this documentation in. It's a little bit more work, but therefore you sell them very quickly, and you don't have to take huge discounts at that point.
Right.
Wonderful. Because let's say if somebody comes to you, assuming somebody comes to you with a fully documented, with a perfectly executed note and deed of trust and note, with a financial statement from the seller, with the clear ability to pay that for like forever, with the so no concerns financially from the seller's from the buyer's point of view, with the right to run the credit scores, with the personal guarantee, with all these different things, and they come to you with a $40,000 note, and the loan to values are all right. And the interest rate is 12%. How much discount, with like roughly speaking, would they need to give on the note?
Potentially not much. I mean, potentially I could pay par for these notes. If the loan value is, if everything you said is a perfect note, I'll pay par. Again, I want to buy at a 13 to 14% yield, risk adjusted. So,
and if the opposite is happening, but you still, if let's say if it's not well documented, but still just enough for you to actually buy it, what discounts would you see at that point?
Oh, I could buy I've paid as little as 3 cents on the dollar. So
okay, well, that
to buy notes.
Not work, but
So yeah.
In other words, you get the point. Listening to this podcast, So document your notes, right? This was invaluable right now to hear as a confirmation of what I've been saying from stage for like years now. Make sure you get this all right, because then you can do what Bob just mentioned earlier, and you can go sell those notes quickly, build up your amount of like your war chest, and then if you want to create a bunch of notes, which we love our notes, you create a bunch of notes, and we were able to create our notes and cash sales in parallel. So the note creating never affected our ability to create more cash sales. But the note sales were absolutely fantastic when in 2007-8 happened and the market broke in and the house values plummeting. We were sitting there literally with over $70,000 a month coming into cash flow into debt-free, and we were starting going shopping. We started buying houses.
Perfect. That's where you want to be.
Exactly, because we had that stability, we had that cash flow for years to come. And we kept buying and bought a very nice portfolio of single-family homes, free and clear, which is now financially speaking not the smartest I know. But then, but they provide us now a continuous six-figure income that will be passed on to our daughter.
Yeah, that's awesome.
Right. So with that said, thank you very much. I mean, do you have any kind of like parting words or for let's say beginning investor that's thinking about getting into real estate, what they should be looking at or what they should be worrying about, or just like words of advice?
You know, I think you've done it. I mean, it's interesting. You've built a model that can be active or passive, which I love, right? So depending on, because a lot of people getting started want to do it part-time. So it's a perfect scenario. I think, the takeaway is, hey, look, there's a lot of opportunity out there, a lot of tools and a lot of vendors like us that can help. But at the end of the day, do your homework and don't take shortcuts, and work your system. So sounds like it's an amazing plan you guys have, and there's many other strategies as well. Pick one and work it. But pleasure to be here with you today.
Thank you very much. Thank you for having me, Bob. With that, where can people find out about you? Of course, I want to give you an opportunity to.
Yeah, Aspen Funds, like Aspen, like the tree, funds, FUNDS.US. And they can go find out more about what we do there.
You can probably buy notes, become an investor, sell notes, all of the above, right?
Yes.
Okay, Aspen Funds. .us. All right,
That's
wonderful. We'll definitely put in the show notes, put in the comments below. With that, thank you very much. That concludes our latest episode of the Forever Cash Life Real Estate Podcast, where we talk about cash flow, land flipping, real estate, any different ways to generate wealth and financial freedom and live that lifestyle of abundance. All right, with that, thank you very much. Bye-bye.
Perfect. Great to be with you. Bye-bye.
Enjoyed this episode? Then make sure you like, subscribe, and post your comments and questions below the video. We're looking forward to hearing from you.